Good morning or good afternoon, wherever you're reaching us. I'm Alex Tapscott, and welcome to today's Crypto Talks. Over 1,000 people have registered for this event from dozens of countries, and I've received almost 100 questions pre-submitted. So there's clearly a lot of interest in this important topic, and I fully expect this to be a lively and rich discussion. As always, a replay of this event will be made available to the public in case you feel that your question wasn't answered, or if you wanted to replay, there's always available. To learn more about Ninepoint and the digital asset group, we encourage you to check out some of the following resources. Blockchain Revolution, a book that I co-authored, remains the best-selling book about blockchain and is a great starting point for your digital asset journey. If you're specifically interested in financial services, check out Financial Services Revolution, which focuses on digital assets and DeFi. Also, I co-host a podcast, DeFi Decoded, on Ninepoint Partners YouTube channel. It's also available through Spotify, Apple, and wherever you get your podcast. In general, I would just say check out the YouTube channel. We've got some great stuff there, including some crypto talks with Perianne, our guest for today, but also Cameron and Tyler Winklevoss, Chris Giancarlo, Ryan Selkis, and some other upcoming guests, which are terrific. And finally, please follow us on Twitter at NinepointDAG. Okay, here we go. This is a pivotal moment in the trajectory of Bitcoin, digital assets, DeFi, and blockchain. The asset class today is $3 trillion and growing quickly. Bitcoin itself is worth more than $1 trillion, which is more than every Silicon Valley startup since 2009 combined. For regulators, policymakers, and central bankers, digital assets were once safely too small to care. $3 trillion later, are they now too big to fail? Or put another way, are they somehow too revolutionary and unwieldy to regulate and oversee using traditional means? The pace of technology innovation is accelerating, and many existing institutions lack the know-how or capability to regulate or oversee it effectively. Governments and regulators are important stakeholders in financial markets and indeed in many aspects of the economy. They play a key role, and so they must adapt to these changing times. But the challenges are significant. Governments are used to traditional custodial financial intermediaries, but many crypto asset use cases, such as DeFi, are non-custodial, or in other words, self-custodial. Regulators are used to overseeing companies and individuals, whereas many emerging projects are not companies in the traditional sense, but decentralized autonomous organizations, or DAOs. We'll get to that later. I think by failing to understand how this technology works and how it's evolving, governments could inadvertently derail one of the fastest growing and most promising sectors in the economy today. Bitcoin and other crypto assets have exploded in size, popularity, and usage. And this has really set off a spark that's captured the imagination of entrepreneurs and investors and business leaders everywhere. But it's also raised eyebrows in Washington, D.C., in Ottawa, and other halls of power. So to help us make sense of all this fast-moving and critical issues is Perianne Boring. We're very excited to have Perianne join us today. She is the founder and president of the Chamber of Digital Commerce, the world's largest trade association representing the blockchain industry. The Chamber's mission is to promote the acceptance and use of digital assets and blockchain-based technologies. Working with policymakers, regulatory agencies, and industry, the Chamber advocates for a pro-growth policy environment that fosters job creation, innovation, and investment. Perianne was named one of America's top 50 women in tech by Forbes, and in 2016, she was named one of the 10 most influential people in all of blockchain by CoinDesk, the leading industry publication. So with that, Perianne, welcome to Crypto Talks.
Thanks so much, Alex. It's great to be here.
Okay, well, the timing for this could not be better because yesterday, Joe Biden signed into law the infrastructure bill that has been working its way through Congress for many months. Now, people think of infrastructure as roads and bridges and tunnels and things like that, but the law itself actually contained something new that's important to the digital asset world. Can you help explain what that was and what impact it has?
Yeah, no, absolutely. And this is something we've spent the greater part of the entire summer working on. So I do believe that blockchains will be critical infrastructure in the digital economy. And this will serve as the tunnels and the roads and the bridges in our digital economy. However, if we regulate it out of existence today, that could be pretty detrimental to the development of this technology. So the infrastructure bill, which was signed into law by President Biden yesterday, included a provision related to digital asset taxation. This provision has been pretty controversial. There's been a lot of media attention and just a lot of outspoken folks in the industries have spoken out against it. So maybe I'll just kind of break it down about what people are upset about and kind of talk about kind of what the state of play is right now. So there were a number of things that were pretty concerning in the bill, but the two most important ones are, one, the definition of a broker. So this tax reporting provision has to do with information reporting for digital assets. So the broker definition defines who is responsible for collecting information, reporting information, sharing that with the IRS, and then also issuing things like 1099s to their customers. So that broker definition is relatively broad and expansive. And there's a number of lawyers who have read that and said, look, this is too broad. This could loop in all sorts of things in the digital asset ecosystem that do not have access to this type of information, and therefore it would be impossible for them to comply. So these entities would either be forced to shut down, operate illegally, or go overseas. And the way that definition is written today, some have argued that it could include miners. So companies like Bitcoin miners or validators and node operators. Yeah. The definition, as it was passed into law, is relatively broad. I will say that as of the chamber and other folks lobbying on this bill created a lot of attention about that expansive definition. And we were successful in getting a number of assurances from Treasury and the White House and Congress that even though the definition seems very broad, they have no intent to loop in miners and node operators and validators. So the drafters of the bill, Senator Portman and Senator Warner, issued what's called a colloquy the day after it passed the Senate. And that colloquy directs the IRS to exclude node operators and miners and validators and developers and others from that definition of a broker. So a colloquy, it's not law, but it is an official part of the legislative record that directs the IRS to not include those entities. And then both the IRS...
It's interesting that, not to interrupt, but there was the colloquy, there was the assurances, and I think people in the industry were asking, well, why not just put the language? Why not just revise the language? Were they trying to create some wiggle room for them to change that interpretation? Like, that's the part that I've always been confused about.
Yeah, and that's totally fair. And I think as advocates, we should say, just put it in the law itself. And that's what the whole fight was about. Yeah. But you have to also understand that the infrastructure bill has a huge amount of political will from President Biden himself behind it. So before the bill was introduced, we spent several weeks negotiating with the Senate offices who drafted this bill, with White House and Treasury, on these exact definitions. And we got about 90% of the things that we wanted and what we asked for. And that bill was even more expansive. Like, we whittled it down, we whittled it down, we whittled it down. And then it came Sunday night and it's like, we are out of time. The bill has to be introduced. There's no more time for negotiating. Even though we agree it's not where we want it today, it has to go forward, but we'll provide other assurances. And that's how it happened. And that's how we got to where we are. So this was not just about good policymaking. This was really more about fulfilling political will. Right. And fulfilling a will of the president of the United States. And, for me at the chamber, and someone who used to work on the Hill, I think as we're developing public policy, we need to do so in the best way possible. But politics and policy always goes hand in hand. And we were the victim of that in this process. Yeah.
Well, we started off by talking about how the sausage gets made, but and it's obviously the most critical part of this whole process. A law that could have impacted an entire new industry was shoehorned into a seemingly unrelated bill, even though I agree that blockchains are infrastructure for the digital economy. A lot of critics of the bill, especially people in the crypto community, would make the argument that this was a way to try and jam through something that would put a lid on the industry as a whole. And a lot of people think that governments, whether it's the US government or others, are not keen on the industry at all, and in some cases may hate Bitcoin. Is that a fair assessment in your opinion?
There's definitely a high degree of skeptics and criticism throughout the government. This particular provision was a pay for. Part of getting the infrastructure bill passed in the laws, it had to be paid for. And this scored very high. It scored close to $30 billion. So I think really the true purpose of this provision was to pay for the infrastructure bill. But you are correct that there is a high degree of criticism from the government. And as you stated in your introductory remarks, Alex, about this being a pivotal moment. I completely agree with that. We are really in an extraordinary moment for crypto policy. We have the highest level of policymakers engaged, making crypto a top priority across all of government. So it's not just tax. You're also seeing very similar debates happen at the White House. We've had conversations around stablecoins this summer as well, at the SEC, at the CFTC, and Congress broadly. So this is the moment. I mean, this is really a moment where the most important policy issues are being debated and decided on today, and they're going to set the trajectory for how businesses can build and invest in digital assets for decades to come. So we have arrived, and this is the time to press in and to support the policymaking process to ensure that we're not over-regulating and that we're not stifling development and innovation of this technology.
Yeah, I like to say that the US is a leader in crypto in spite of its regulatory and administrative regime, not because of it. The reasons why the US remains the leader in this space is because of a culture of entrepreneurship and deep capital markets and a massive common market and all those other things that we know about the United States. But it could be possible that this new era of the digital age, this second generation of the internet, however you like to call it, could be stifled, right? Because of those changes. On the other hand, the fight over the infrastructure bill actually, I think, uncovered that a lot of people in government are really quite keen on this and open-minded, and they now have a name called the Crypto Caucus. I remember when you and I first met, must have been maybe 2015. I think the Crypto Caucus was like one person. I think it was Mick Mulvaney. And now there are, half a dozen senators and governors and all these other people. So who are those? Who are the people in the government in the US today that are really encouraging this industry's growth and encouraging thoughtful innovation in the space?
Yeah, and we do have the benefit of the chamber. We're in our 8th year of operations this year, so we're really at the ground floor and at the very beginning stages of the public policy process for crypto. The Congressional Blockchain Caucus was founded in 2016 by Congressman Mick Mulvaney and Congressman Jared Polis. Mick Mulvaney is now an advisory board member of the chamber, but after he left Congress, he went and worked at the White House under President Trump. And Jared Polis is now the governor of Colorado. Today, there's just under 30 members of the Blockchain Caucus, and that only includes members of the House of Representatives, not the Senate. Yeah. There's about 30 members of the House who are a part of the Blockchain Caucus, and that really is our core group of advocates and supporter, and where the House is coordinating on efforts to support the growth of this industry in the United States. Above and beyond that caucus, we do have supporters in other areas of government and leadership throughout the House, throughout Congress more broadly. So I just also mentioned the Financial Services Committee ranking member Patrick McHenry is also a crypto advocate and supporter just yesterday. He, as well as other members of the Financial Services Committee, released their principles related to CBDCs, central bank digital currencies, and stablecoins, which were very positive in nature. Turning to the Senate side, we now have what's called the Innovation Caucus, and that's led by Senator Cynthia Lummis. Senator Lummis personally owns and is an investor in Bitcoin, and she's one of the top advocates for Bitcoin and cryptocurrencies on the Senate side. Through the infrastructure bill, we kind of had a really interesting advocate in Senator Wyden. So Wyden is a Democrat. He leads or chairs the Finance Committee. And he really came out in support and sponsored amendments to address that problem I was talking about the definition of a broker. And then within agencies themselves, there's a number of supporters throughout the regulatory agencies, including prudential regulators and law enforcement. So when we first got started in 2014, there was maybe one or two people, I think, in all of the policy environment that could tell you what Bitcoin is or could tell you what blockchain is. Today, that number is much, much, much larger. And that very much has to do with just the number of education and advocacy that's been going on for the greater part of a decade from the Chamber and other groups active in DC. But we still have a long way to go. But we definitely have very strong advocates and supporters all throughout government.
Yeah, I think it's hard to understate how instrumental really two organizations have been to this entire thing. One is the Chamber of Digital Commerce, and the other is Coin Center. Both organizations founded, when this industry was a rounding error in the eyes of government, and both groups have really been instrumental in advocating and educating. And I think a lot of that success with this crypto caucus is actually your work, because you've been so great at engaging with lawmakers themselves. So I don't want to change the subject, but this is something I think people might be interested in, which is there any sort of partisan divide on this issue of Bitcoin? I can see an argument for each side. If you're on the left, you might see Bitcoin as a way to break up the monopoly of too big to fail banks and other large corporations, which you might feel are in a predatory relationship with their customers or taking advantage of them, for example. And if you're on the right, I can see, the idea of freedom, basically a way to store and move value that is not connected to a government, not backed by government fiat, right? And the ability to express your freedom of speech with how you spend and store your money, right? So I see the argument on both sides, but how is that playing out in practice?
Yeah, so we have always operated with the principle that this absolutely should not be a partisan issue. Technology in general shouldn't be a partisan issue. And it's really only been until recently that we're starting to see that divide happen. The majority of the criticism today is coming from the left, almost to a lot of people's surprise, for the points that you just mentioned, the idea of consumers and individuals being able to control their data, to control access to their identity and their money, quite frankly. These are all things that have very much been, I think, a key part and pillar of the social and liberal agenda. And here we are, where we have a technology that really could enable all of those things that Democrats have been campaigning on for decades, but yet they have really failed to recognize that connection. And that's I think one of the biggest challenges we have as a community today, is helping our policymakers understand how this will benefit the different communities. Those who don't have access to basic financial services, those who could really benefit from true financial inclusion initiatives. And I think the reason why is because this technology is still very young. Bitcoin just turned 13 years old on Halloween, just a couple weeks ago. So we're still in early days of developing this ecosystem, and the use cases and things like social financial inclusion are, I think, a big part of what many people want to see this technology used for. But we're still building the infrastructure, the roads and the tunnels and the bridges, the on-ramps, the off-ramps, the exchanges, the compliance procedures necessary to operate businesses here. And that's going to take a little bit longer to develop. But if we don't recognize its potential and we stifle its growth today, there could be some pretty significant opportunity cost that we're boxing ourselves out of. So that's a big part of our message, at the Chamber, is to make sure that when we are looking to restrict a technology or restrict companies being able to build with a potential technology, we need to take the opportunity cost into account as well.
Yeah, I think it's, I shared those two sort of narratives or spins on why, one side might like it more than the other. But I think the main takeaway from that brilliant explanation is that technology should be nonpartisan. And throughout history, enlightened policymakers on all sides of the spectrum have created the conditions for that to succeed, right? Like the internet in the early 1990s, there were calls at the time for anybody who launched a website to get a CB radio license, right? There were maybe a few hundred available. So that would have significantly curtailed the growth of the internet, because there are people with legacy attitudes who thought that this was, well, like a ham radio or something, and you needed to be licensed to do it. But the U.S. Took a different tack. The Telecommunications Act was updated to make it so that internet service providers were not held liable for content that went through their pipes. And as a result, the internet exploded in value and created trillions of dollars, and then changed the world for better or for worse, but I think broadly positive impact. And I feel like we're at another one of those inflection points, where this is 1995 all over again. And every country, whether it's the US or Canada, has an opportunity to create the conditions for this new technology to succeed. And right now, I think that the jury is out which way we're going to go at this point in time. I think that it's still very much foggy. Do you agree?
Absolutely. And I very much like that parallel that you draw between the internet. And I think when it comes to internet policy, the U.S. did a lot of things right. But that was a very different kind of scenario. The internet was, invented in DARPA within a government agency, and then and it was really created for defense purposes. But then, the policymakers recognized how promising this technology could be, and the Clinton and Gore administration passed laws that were a whole of government approach to build out the guardrails to incentivize the private sector to commercialize this technology. We were incredibly successful at doing that. And I think that really had a lot to do with the huge amount of growth the United States economy saw throughout the 80s and the 90s. Fast forward to today, I strongly believe that blockchain technology will be as impactful as the internet was. Mark Andreessen had said that himself. He has said that blockchain technology is just as an important technology as the internet itself. And if they had blockchain technology back then, they would have built that into the browser when he was building and launched Netscape. This technology will impact many different industries, not just financial services, although financial services is the first to be disrupted. And we should, have, and this is why at the Chamber we developed what's called the National Action Plan for Blockchain. And we are calling on the highest levels of government to first and foremost recognize the critical importance of the technology, and then two, put together a framework to help and guide the private sector on how to commercialize this technology. We're not doing that today, but who else? Who is everybody else. And it was, a couple years ago, we commented on a series of policy proposals that were put out by the European Union. The European Union put out a paper, and I want to say this was 2016 timeline. And in that paper, they talked about how the US approached internet policy. And they said, we missed it. The EU missed it. This was all, the US took the lead, and we recognized that we missed a big opportunity. We will not make that mistake with blockchain. And the EU has launched a blockchain observatory. And if you go to that website, it's a government hosted website. On the very front page of it, even today, it says we created this to cement our role, the EU's role as the leader in the blockchain ecosystem. Why aren't we doing that in the US? How are we missing it that far? So I think a lot of institutions and a lot of governments recognize the importance of this. And I think it's still really to be determined who ultimately will be the greatest beneficiaries of this technology.
I agree. So I want to switch to some questions from the audience. And there are a number that I've tried to synthesize here because we received, as I said, almost 100 questions, but they're around certain specific areas. So we've mentioned this idea of a stable coin. And maybe for people who are listening who aren't familiar, a stable coin is a digital asset that is pegged to some kind of traditional asset. It's almost always the US dollar, right? So, a stable coin, if it works correctly, maintains a peg to the dollar, 1-for-1. So, for example, USDC, a stable coin with almost $40 billion of circulating supply, holds its peg. There has been discussion recently, Perianne, about from the SEC and others that stable coins could be securities. Gary Gensler, the chairman of this SEC, who I think people in the community were cautiously optimistic would be open-minded, has seemingly changed his perspective. He said that the world of crypto is the Wild West and stablecoins are the poker chips, which I think is unfair for a number of reasons. Number one, this is a $3 trillion asset class. It's created thousands of jobs and a lot of wealth for a lot of people. But also, it's an inaccurate analogy. Poker chips are a medium of exchange inside of a closed environment like a casino, where stablecoins can actually be used for almost anything. They can be used to, buy and sell crypto assets. They can also be used as a way to send a remittance payment to your family who's living in another part of the world, right? So I think that it was a cute line, but fundamentally inaccurate. But the key question remains, which is, what exactly are stablecoins from a regulatory perspective? Are they securities? Most people think of a security like a stock as something you buy to make money. So if I'm buying it for $1 and using it to buy something else for $1, how on earth is that a security? What's your view on that?
Right. Okay. So stablecoins is a huge priority for U.S. policymakers today. The president's working group just issued its report on stablecoins with their policy recommendations for regulatory oversight of stablecoins. So the president's working group consists of the head of the Fed, so that's Jerome Powell, the head of the OCC, so we have an acting chairman in there today, Michael Hsu.
Yep.
The head of the CFTC, again, there's only an acting chairman there. We don't have a confirmed chair. That's acting chair Benham, and then the head of the SEC, Gary Gensler. So the four of them came together and issued their report with their recommendations. And their report was limited to U.S. pegged stablecoins that are backed 1-to-1. When the President's Working Group announced that they were doing this in-depth study of stablecoins, we also convened our membership so we could put forward our own policy recommendations for stablecoins. We issued that paper on October 16th. If anybody wants to read it, you can check it out on our website, digitalchamber.org. It's on the homepage currently. If from a policy perspective, the conversation again is really focused on US dollar 1-to-1 backed. The big question of is a stable coin is a security, that's a really important question. We have taken the position that absolutely not. So in order for a digital asset to meet the definition of a security, there has to be an expectation of profit. And if they're a stable coin and they're meant to maintain a one-to-one value to the dollar, there's clearly not an expectation of profit. So that's one part of the argument. The other part of the argument, and we talk about this in length in our paper, is that these are intended to be payments instruments used for payments. And if they are regulated by the SEC as a security, it pretty much, one, destroys that potential use case. And one of those important benefits of stablecoins is that this really could be a potential promising technology for financial inclusion initiatives. But if they're regulated as security, that won't happen. But two, if these are a consumer-related application, that you actually have less consumer protections if they're regulated by the CFTC, because then it really could impact the authority of the CFPB, who is our consumer regulator in the US and who has all the expertise as a consumer regulator. So there's two arguments there that we've put forward. And this is, I think, one of the most important debates that's happening today in Washington. And of course, that the president's working group, or the PWG paper, it asked Congress to prudentially regulate these technologies. So in order to get Congress to pass that legislation, that's a multi-year initiative. So this is something we will be talking about for the next couple of years.
I would say so. And of course, we're only talking about one kind of stablecoin. And those are, the ones that you said are centralized stablecoins, meaning there's a digital asset that's issued backed by reserves of US dollar or equivalents, hopefully, in a regulated US financial institution. So, Circle's USDC, the one that I mentioned, is a good example. Of course, there are other kinds of stablecoins in the world of DeFi where the collateral is not sitting inside of a bank. It is crypto assets held in a smart contract. That supply is managed dynamically based on the amount of issued stablecoins, which sounds like a mouthful. But actually, stablecoins like that, such as UST or DAI, are in themselves in the billions of dollars. And in the case of DAI, which is a decentralized stablecoin, it does more daily volume than Venmo. So the rules that we're talking about here are applying to this one kind of stablecoin. Now, perhaps they will argue that things like DAI, which is based from a U.S. team and quasi-American in nature, is captured in that. Who knows? I'm not the person to make that call. But it's just an example of how nuanced all of this stuff is. We got a couple questions from the audience. I think we've mentioned this term before, decentralized finance, or DeFi. So if you'd like, you can go online. We've got the podcast DeFi Decoded, where we go through this. But basically, if Bitcoin enabled the way people to move money peer-to-peer using this native currency called Bitcoin, the idea behind DeFi is that it enables peer-to-peer models for all the different elements of the financial services industry. So not just storing and moving value, but getting access to credit, getting access to growth capital, trading, insurance, risk management, and so forth, right? And we've seen the growth of this industry explode in terms of new users, new apps, and then the metric that people like to use is just total value locked. In other words, sort of like deposits in the DeFi world. So again, if you're not familiar with DeFi, do check out the content that we have online. But, Perianne, I would say that DeFi is probably the fastest growing, or one of the fastest growing and most exciting areas in blockchain innovation. And it's also one that I think holds great promise for the issues that you've raised around making the financial industry more private, more democratized, more efficient. But there's some concern that the party is going to end before it even gets started, and that the regulators are going to come down hard on DeFi. So what do you think? I know that's sort of an open-ended question, but what's your opinion on that?
Yeah, no, I agree with that. And an example where we're seeing
which part, that the party will be crushed?
No, that there is an effort to rein this in from
Right.
policymakers. I mean, it's to be determined if they'll be successful at doing that. I'm incredibly optimistic about the future of this space, and we've got a lot of expertise working with our policymakers to try to shape that process as much as possible. So again, I'm optimistic, but I do want to be pretty, straightforward that there are absolutely efforts throughout government to try to rein in what's happening in the DeFi space. And there's a lot of people that believe that the stablecoin effort is really the top of that. So stablecoins fuel a lot of the activity in the DeFi space. And because, in the DeFi networks, if something's truly decentralized, there's not a central party that you can go after and pull into government oversight for reporting or supervision or record keeping purposes. But stablecoins, because of what you just mentioned or what you just explained, if they're one-to-one backed, if you have an issuer, you clearly have a central party, a central intermediary who's operating that network. And just to be clear, we do believe there needs to be oversight of those types of entities. However, what the PWG put forward was, essentially a federal mandate that really could have a huge impact on a number of major stablecoin projects that are in operation today that likely would be quite detrimental to the growth of this ecosystem. And again, if they're considered securities, that would really deter a lot of the use cases for stablecoins. So yes, there are efforts to stifle the growth of DeFi, and this whole stablecoin project is the biggest one right now. But there's others. I mean, you're seeing this in the AML space with what FATF has put forward, and you're also seeing it in the tax space. We talked about that infrastructure bill. I talked about, we negotiated those definitions down before the bill was ever introduced, and it specifically had DeFi language in that bill. I mean, they were really trying to target the DeFi space, and luckily we got a lot of that stuff out of there. But there are a lot of concerns with what's happening in DeFi. Some of it's fair, some of it's not, some of it's very discriminatory. So again, I started the call with this. We are really at a critical moment. Like, the types of issues we're debating today are going to set the trajectory of how companies and investors can build in this space. And now is the time to press in. So I certainly encourage those who are active in this space, who are investing in digital assets, who are investing in companies that are building in the digital asset space, companies that are building in the digital asset space. If you're not engaged in the policy conversations, please do, and make sure that your voice is heard, because this is the time where those most important questions are being answered and decided.
Yeah. One of the things that you do is help to dispel myths and rumors about digital assets. And I think there's one in particular that it seems hard to shake, which is that Bitcoin's favored by criminals because it's anonymous, and that increasingly they're using Bitcoin over cash. What's the truth behind that?
Well, there's no truth to that. It's completely false. According to Chain Analysis, which is one of the industry leading blockchain analytics providers, less than 1% of all crypto transactions are linked to illicit activity. It's actually 0.34% of all transactions using cryptocurrency are linked to illicit transactions. So the idea that crypto is predominantly used for nefarious purposes is completely false. It's not true. That is a myth.
Yeah. And I think if people want for context, I think the number for cash is like 2 or 3%. I don't know the exact number, but it's 10 times more common, or not more common, just 10 times more of all cash.
Cash is still king. Yeah. And if we're going to write rules with the premise of, if a currency is aiding illicit activity, we need to ban it. Well, we should probably start with the US dollar. I'm not suggesting we actually do that, but if you applied that logic, that's where we would end up. But this myth really has shaped a lot of policy going back to the infrastructure, but we haven't talked about this yet, but there's another section in that bill called 6050I. And there's a lot of people on crypto Twitter talking about it right now. But what that provision does is it says anytime cryptocurrency is used to buy anything for more than $10,000, the merchant is required to collect the name and the social security number of the purchaser using crypto. And so this puts crypto on par with cash transactions. And the whole point and why that was put together is because if someone's buying, we'll just use the example of a car, and you want to buy a car for 20 grand and you show up to the car dealer with a huge duffel bag of cash, the likelihood that that person has that cash or where it came from, it's more likely that it came from a criminal use. That's not, so that they're applying that same logic to crypto. Now, in crypto, if you're purchasing something for more than $10,000, the likelihood that the person with more than $10,000 in crypto, that it came from illicit purposes, is less than 3.4%. So that provision in the infrastructure bill is highly discriminatory, in my opinion. And it comes from that myth that crypto is really predominantly used for illicit activity. And it's just not true.
Yeah. Yeah. And I think it's so important to reinforce that because there's so much misinformation out there. There's a bunch of questions here that I'm going to just address a couple of them quickly. Someone says, with new cryptos coming out, the momentum that is going up looks good, but when it goes down, are there any earnings on any of these holdings to back them up? And I think that's a longer conversation that I would encourage you to check out our podcast on DeFi Decoded and some of the other content we've done. I think the key thing there is that there are many different crypto assets, but not all of them are currencies, right? Things like Bitcoin are designed to be a medium of exchange and a store of value and a unit of account. And Bitcoin functions like digital gold for the internet, and I think that's a very important use case, and I think it has a very bright future. But there are many other different kinds of digital assets out there, right, Perianne? Like there are securities tokens. We're talking about stable coins. We're talking about well, we haven't yet, but there are NFTs, non-fungible tokens. And each of these different digital assets has their own unique properties. And I think that's sort of key to the messaging that I try to talk about, which is that this is a general purpose technology, right? Like the internet. It's being used to design and build different kinds of assets and applications. And, right now, those things that I just said are what they're being used for today, but you can't really predict how they'll be used in the future. There's so much innovation that's happening. One of the areas of innovation is in and around central bank digital currencies. And I've highlighted there are 10 different questions from different people in the audience about CBDCs. Will the Canadian banks develop their own digital currency? Would a private bank consider creating its own US dollar-based stablecoin? And someone even asks, well, I thought this was interesting. What would be the miners supporting the infrastructure of a potential CBDC? So there seems to be quite a few questions here about central bank digital currencies. What do you? And I know that in the government in the U.S., there's no consensus. Even within the Federal Reserve, there are people who are very in favor and not so in favor. So can you help us just sort of make sense of this? Maybe to just define a CBDC and tell us what the state of play is in the U.S. today.
So as a central bank digital currency would be a digital currency that's issued by the central bank, not the private sector. So very, very different than a stable coin. They're being innovated by the private sector. So this would be public sector development of this technology. So according to the Bank for International Settlements, 80% of central banks today are already exploring and or actively building CBDCs. In the US, you asked about the state of play in the US. In the US, it has not been determined if the Fed will issue a CBDC, a digital dollar, if you will. There's a lot of stakeholders involved. So you have the Fed, obviously, as the primary stakeholder. You also have Treasury and then Congress, so the relevant committees with jurisdiction over the Fed. As you may have seen, so the Reserve Bank of Boston has really taken the lead in doing research for the Board of Governors of the Fed on CBDCs. And the head of the Reserve Bank of Boston just stepped down within the past couple of weeks. And when he left, he made a statement and he said the biggest issues around a digital dollar are not technical, they're political. There's a lot of legal questions around, does the Fed have the jurisdiction and the authority to issue a digital dollar? And so if it's not, that means it's going to require an act of Congress. And as we all know, getting anything passed through Congress is a huge feat and usually takes years to get those types of proposals through the legislative process. But the Board of Governors is undergoing a robust study. So they're really taking an academic approach. They're spending a lot of time looking at this from an academic perspective on, is a CBDC necessary? If so, how should it be done? What are the legal things that need to be thought through? What are the technical things that need to be thought through? And we are waiting for the Board of Governors to issue their CBDC report. It was supposed to be issued in July. As of today, November 16th, it still hasn't been published, so it's obviously been stalled a bit. But that paper, and we did help support the board in their study around that, it will outline the Fed's thoughts around how to move forward around a CBDC. But there has not been a decision made if the Fed will build one. I think they will over time. I do think this is one of those when, not if questions. I think at some point we'll see the majority of central banks starting to issue CBDCs. And this is more of a a technology thing where technology is moving forward and everyone else is going to have to progress. So I think it's inevitable, but what kind of timeline will that be? And if this is put off long enough, what types of impacts could that have on the role of the US dollar as a world reserve currency?
Yeah, well, I'll editorialize on the Canadian side. The Canada joins dozens of countries that have announced a pilot or a study or some other, first initiative in the CBDC space. But at this stage, I think we're a very long way away from implementation at any sort of scale. And I think that's probably fair for most CBDC initiatives. And, advocates of CBDCs would say that, by the government issuing its own digital currency, it's going to lower barriers to financial inclusion and could make monetary policy more responsive because you can, see how money is moving through the economy and, tinker with interest rates and so forth. And opponents say, well, even if that's true, if the government has perfect information about how people are spending their money, then that is an invasion of privacy. People forget that cash is actually anonymous, and that being able to spend money without sharing key information about yourself with everybody you interact with is an expression of personal liberty. So I think that there are a lot of design challenges for building a stablecoin in a free market. It's easy to build a stablecoin in China, right, where it's a perfect, fit for a totalitarian, regime. But in the U.S. and hopefully in Canada, they're thinking about that issue of personal privacy as well. I know that Chris Giancarlo, who's a friend of yours and a big, long-time supporter of the chamber, former chairman of the CFTC, who was a guest on cryptoTalks, has raised these issues before as well. Do you see that as being key to any decision in this area?
Absolutely. And Chris, Giancarlo is one of our advisory board members of the chamber, and he separately is the founder of the Digital Dollar Project. And the Digital Dollar Project is leading from the private sector perspective in supporting government and all of the relevant questions and studies that need to be had to guide the process for building a CBDC in the United States. So just yesterday, the House Financial Services Committee Republicans released their central bank digital currency principles. So the principles that they believe should be put in place for the US to move forward with a CBDC. And those principles, I'll just summarize them very quickly. One of them is ensuring privacy and security. And they go so far as saying that the Fed cannot issue a digital currency without congressional authority. They also say that one of their principles is the private sector must lead the way, and that stablecoins hold a promise as a cornerstone of a modern payment system. So I found that to be incredibly encouraging. And then the other principle would be to address the inefficiencies in the US payment system. So there absolutely is support for that. And I think that is the most important question we need to take into account as central banks are looking at potentially building and issuing their own digital currencies, are those privacy considerations. And in the United States, we have the unique benefit of having the Fourth Amendment, and that cannot be trampled on with the issuance of a CBDC.
Remind our Canadian audience what that amendment says, what it's about.
Yeah, that's the right to not have unreasonable search and seizure. So the right to privacy, that's part of our Constitution, and that is a foundational principle in the United States.
Right. A couple of we're down here to the last 10 minutes. There's still so much more that the audience wants to know. There has been some criticism of Bitcoin as being a polluter because of the proof of work mining that's involved in validating blocks and securing the network. It uses a lot of energy. Do you worry that is going to be a political wedge issue that's going to cause probably people on the left to take a harder tack on Bitcoin?
This is another one of those myth issues that really just gets under my skin. So does it require energy to run the Bitcoin network? Yes, it does. But what is really missing from that conversation is how Bitcoin mining is fueling innovation and investments in renewables like we've never seen before. And some of the most prominent private equity groups have even put forward a series of studies showing that when you take a renewable facility and you couple Bitcoin mining with that facility, it creates a whole new economic model, and it's incentivizing a whole new set of investment and innovation into renewables. So that's really the conversation we should be having. We are very concerned about these misconceptions that Bitcoin is bad for the environment because it uses energy. And we have established a mining initiative at the chamber. We do represent a number of Bitcoin miners at the chamber, and we currently have an educational initiative underway helping people understand exactly what proof of work is, how, what does energy consumption actually look like, honestly, in the Bitcoin ecosystem? What types of benefits is Bitcoin mining bringing to renewables, into the industry, the energy space. So this is, another area where you have these myths, you have these misconceptions, and could that lead to bad policy making? Absolutely.
Yeah, it's a very nuanced issue, right? So on one hand, Bitcoin mining, proof of work mining uses energy. On the other hand, it's probably one of the greenest industries in the world because of the economics. You can put a miner next to a wind farm that wouldn't otherwise be built because it can be very far away from a normal, consumer of energy, like say a city or something like that. But on the other hand, it's still using, half of a big number is still a big number. So, from our perspective at Ninepoint, we see that Bitcoin mining can help to actually green the planet. But we also see that until we get to that point, it's important to address some of these concerns, both with the education that you're talking about, but also we offset the carbon footprint of our Bitcoin ETF so that it's ESG compliant, in other words. And I think that probably we won't have to in a few years because the Bitcoin mining network will be transitioned to something that is fully sustainable. Let's talk about just a couple more questions. We've talked about these challenges to crypto and to DeFi and to the blockchain space as a whole, and new regulations, what they could mean for the space. But at this point, is there really any chance that governments can stop this from happening, or to really truly cripple it in a meaningful way, or is the genie out of the bottle? I can't help but think that, this is a global technology. Talent, capital, companies, projects are all distributed around the world. Plenty of jurisdictions are highly encouraging of blockchain innovation, like say Singapore, Dubai. Won't any attempt to crack down just push it all offshore and have it, have the innovation happen somewhere else and not in the United States?
Yeah, a big question that we get from investors is, will the government just ban Bitcoin, or will the government kill crypto?
Yeah.
And
I think a lot of our audience wants to know that, as well. Yeah.
Yeah, my opinion is no. In the US, that question has already been debated and decided on.
Yes.
One, before crypto was even a thing, there was a Supreme Court case here in the US, and it determined that code is free speech. And that's what crypto is. It's code. That's what Bitcoin is. So we believe is protected by free speech, for one. Two, in 2013, when after Mt. Gox and the Silk Road issue, catastrophe, there was a study, an inquiry by the federal government to ban Bitcoin. And they decided not to, because they saw the promise of the technology and wanted to, decided that this technology, should be allowed to grow and thrive. Katie Haun, who was a federal prosecutor, gave a TED Talk. She was the person who was chosen by the government to lead that inquiry. And she, several years later, gave a TED Talk recounting everything that went into that decision. So you can view kind of that her talk if you want to take a look at it. It's really a fascinating part of crypto history. But no, I don't think the government's going to kill crypto. And quite frankly, even if all of this wasn't a part of the factor and a government wanted to kill it, in order to destroy Bitcoin, you would have to cut off everyone's access to the internet around the world at the same time. And the likelihood of that happening is next to zero. And if that did happen, I think we have much bigger issues to address as a society. So yeah. I just don't think that it's a very likely future for crypto.
Yeah. Well, Katie Haun has now gone on to be a GP at Andreessen Horowitz, which is the largest investor in this ecosystem. Mark Andreessen, inventor of the web browser, sees the same potential in blockchain. I actually remember that TED Talk quite well, because I gave the TED Talk right after Katie at that event. It was TEDx San Francisco. And
you were there. Yeah, that's awesome.
Yeah, we were reviewing our speaking notes in the green room before she went on. The talk also addresses the whole question of how do criminals use Bitcoin, right? And she was telling this perfect story, really a true story, about how, as a prosecutor, they were able to use the blockchain, an immutable record of transactions, to catch a criminal. And the punchline, of course, is that the person who stole the Bitcoin was an FBI agent, I think, which is funny in its own right. So looking forward, last question here. Let's talk about the future of the chamber, and also, what does the next 5 years look like for policy around this space? Do you actually, what kind of policies would you like to see, and what kind of policy do you think we get? And how do you see the chamber's role in that? Sorry for the big open-ended question.
So we have a number of policy priorities at the chamber today. So maybe I'll just kind of highlight our top priorities. We talked about stablecoins. That is a top priority for us at the chamber, and that's an issue we'll be engaged in. I think that's a multi-year policy issue that is going to take years to finalize. The second is tax. So, we talked about the infrastructure bill that has been signed into law. That bill does require the IRS to issue guidance. So really all of the details around these information reporting requirements will come from the IRS. So it is a priority for us to be a resource to Treasury IRS as they're preparing to issue that guidance, to help shape that best we can to ensure that this rule is administrable and workable for the crypto space. Third, another going hand in hand with tax is accounting. So we see that actually the biggest issue to the corporate adoption, the corporate institutional adoption of digital assets is the lack of accounting standards. And here in the US, crypto is currently treated as an intangible, which is very punitive to anybody that wants to put Bitcoin on the balance sheet. So we are advocating to FASB to account for it under fair value treatment and to also have uniform accounting standards for digital assets. Fourth is that jurisdictional issue of when is a digital asset a security and when it's not. And that applies to many different DeFi applications, that applies to stablecoins and other token issuers, and also impacts anyone who would be listing a digital asset for trading purposes. So that's a question we've been asking since 2016. We still don't have sufficient answers from the SEC of clarifying when is a digital asset considered a security and what it's not. So that is still a priority for us. And then fifth, I know this is one of your favorite topics, is an ETF. We are advocating for a spot Bitcoin ETF. We are working with both Congress and the SEC to make the case for why that's best for the markets, for investors, for consumers to have a spot Bitcoin ETF. And you may have seen the co-chairs of the Congressional Blockchain Caucus, Congressman Tom Emmer and Darren Soto, have sent a letter to SEC Gary Gensler calling for a spot Bitcoin ETF. So we are making progress there, but we still have a lot of work to do.
I should clarify that you mean a spot Bitcoin ETF in the U.S. because in case our audience doesn't know, there are a few spot Bitcoin ETFs available in Canada.
That's what I mean. Yes.
Including the Ninepoint Bitcoin ETF. Learn more.
Thank you for your leadership there.
Yes, well, we try. Perianne, this has been an amazing discussion. Those are 5 incredibly important areas. And I think we can all say we're very grateful to have groups like the Chamber and individuals like yourself advocating for the industry with such focus and clarity. And in a way that I think is actually going to move the ball forward. I think that's a very important part of it all. If people want to learn more about what you're doing to understand what the Chamber's up to, or maybe to join if they're in the digital asset space, where should they go?
Go to digitalchamber.org. On our website, you can check out all of our policy positions. We publicly post all of our positions on our website. You can check out who all of our members. You can also apply to join the membership.
Terrific. All right. Well, it's 11:03 EST, so we are past the hour. With that, we will conclude today's Crypto Talk. Perianne Boring, founder of the Chamber of Digital Commerce, thank you very much for joining us. For everyone who's attended, as I mentioned, there will be a replay available of this webcast, as well as the French translation. I'm not sure if we resolved that issue. I know at the beginning, people were having a hard time hearing it. You should be able to hear it in both languages for our folks who would prefer it that way. Thank you. That concludes today's talk, and we will see you next time. Take care, everyone.
Thanks so much.